All right, what's up, everyone? I am live on YouTube right now, and then I'm also live on IG. For those of you, and as people start filing in, go ahead and hop over to YouTube. I wish there was a way that I can put a link. Let's see, just like a share a video. Okay, I don't want to share a photo or video, but yeah, head over to YouTube if you're on IG or wherever you're at, Facebook. I know on Facebook I even put like a link to my YouTube, but sorry, I'm gonna speak more into the mic. All right, let's do this. We'll leave it right here. What's up, everyone? So today I don't want to do a super long one. I was thinking of kind of like different lives to do. It's been a little bit since I've done one. Um, Things have been a little bit busy lately, just with like midterms and everything. And not gonna lie, we're having to do a lot of stuff right now with our company's financials and stuff like that. Not gonna lie, the glare on my glasses is kind of annoying. I'm gonna turn off this second monitor and see if that makes a little bit of a difference. That way, you don't have to actually see a reflection of the screen in my glasses. Don't don't worry, I'm not looking at anything weird or stuff like that. So you're not gonna be like those teachers who are like, well, what are you looking at? You can see in the reflection of the glasses. But today, I'm gonna talk about. I'm sure everyone's heard of it. If you're in business or you deal anything with business or anything with the markets, or honestly, it's a big deal. So it is all over the news, any news station, all social media platforms. But there's a big bank collapse that happened over last weekend, and the main one was Silicon Valley Bank. There was another related bank called Signature Bank that also basically collapsed. I'm going to go do a full rundown of what exactly happened, why did it happen, what does that mean to the average person, just because, I mean, think about most of us, people my age, their 20s, 30s, whenever the financial crisis happened in 2008, like we were kids. We didn't know a lot of stuff that was going on. Our parents, a lot of stuff we were just oblivious to. We didn't really know that much about. It didn't really affect us a whole lot, but it did affect our parents a ton. And by no means, at least right now, I'm going to talk about kind of maybe some predictions I have for the future. But as of right now, it's not. We're not necessarily in a something like the Great Financial Crisis, but it's definitely a possibility that can happen in the near or long-term future. So Silicon Valley Bank, it is kind of what it is. It's actually one of the highest rated banks. It's interesting. We were talking about this for one of my classes I had, and Forbes actually ranked it, I believe it was number one rated bank in the whole nation, Silicon Valley Bank. So this is not good when you have the number one rated bank by Forbes failing, not having enough cash to give to the people that have money in that bank. And I'll explain kind of the specifics about this bank and then just banks in general. If people aren't very familiar, it is very helpful to know how banks work. There's a reason why when you put money in your average bank, Wells Fargo, Bank of America, Chase, even your credit unions, there's a reason why they give you such a small interest rate. And right now, as I'm sure many of you are aware, or hopefully you're aware, that rates are going up, interest rates. And because of that, your bank rates that your bank usually pays on interest on your savings accounts, that they will probably go up, but probably not that much. Maybe up to, I doubt it, maybe up to like 1% or something. In the past, especially with COVID, when rates were basically zero, you got like 100th or 1,000th of a percent in interest, which is literally nothing. It's basically zero. But this bank, one of the highly rated banks in the US, a lot of tech firms, a lot of startups, obviously Silicon Valley, since it was named Silicon Valley Bank, banked there. So a lot of startups, a lot of potential. They would house a lot of their cash there. And I believe they would get loans from that bank as well. So if you think about it, a couple years ago before COVID, business was booming, or even during COVID, if you look at the numbers, the savings rates, just because everyone, tech was booming in COVID, no one was really going to work, so technology, software, all that was blowing up because people were using it more and people were needing it more in their business and to do their jobs. So tech blew up, they had a ton of cash, didn't necessarily know what to do a lot of the cash, so makes sense that they put a lot in the bank, even with normal people. Whenever people talking about individuals and getting COVID checks and stuff like that, they put a lot more in the bank. And now, as interest rates are rising up, inflation, we're getting hit with that. People are saving less and less, and people are actually pulling money out of banks. So, which kind of leads to this whole event crisis that's kind of happening right now. So that's Silicon Valley Bank. A lot of these tech companies are putting their money in there. Really respected, well-known bank. Probably 5 stars on Yelp. I don't know, something like that. But that's what it is. And basically, so I'm going to talk about a little bit how banks work in general. So banks, they advertise, hey, put our money in your bank. You can pull it out whenever. We'll maybe give you a little bit of interest, and your money's basically safe. So that way you don't have to carry cash all the time. If you ever want to send money to anyone or pull money, write a check, take some cash out. Credit cards will provide for that for you with a lot of banks, because a lot of people have bank credit cards. You think of Capital One, you think of Chase Sapphire, you think of Wells Fargo. Like, all these banks have their own credit cards that they issue as well. So basically all your payments and all of your money, for the average person, sits in banks. And for a lot of businesses, you need somewhere to put cash for your business. So banks take money from people, and they give you the right to, whenever you want, you can ask them, hey, I deposited $50,000 with you. I want to take $10,000 out. I want to take $50,000 out. I want to take $5 out. Whatever amount that you have deposited at that bank, you have the right to take it out. But in the meantime, so banks are not required by law to hold 100% of what's deposited into the bank. So our banking system's called a fractional banking system, and this was instituted back in the day. If anyone knows your financial history, I forget what it wasn't. I can't remember if it was the Great Depression. I can't remember this off the top of my head, but there's a really great big depression, recession, and essentially a ton of banks failed. And luckily, this guy, I'm sure probably familiar, there's a bank named after him because he's a banker, JP Morgan. He bailed out a ton of people, because banks, there wasn't any regulation to have a certain percentage of your deposits that people basically given to you to house their money on at the bank. So what happened there was people wanted their money. They were kind of scared. That's typically what happens. Something comes up in the news about a bank, and this is exactly what happened with the Silicon Valley Bank. News comes up, or a recession hits, and people are pulling all their money out, and there's not enough money in cash in the bank for banks to issue back to the people that actually own that money. It's because how banks make money is you deposit money into their bank, they take that money and they put it into some sort of investments. And granted, back in the day, I'm sure they were making a lot more risky investments than they do today. There's a lot of regulation behind what banks can do investment wise to make money, but a lot of times, think of they'll issue mortgages, they'll issue loans, and sometimes whenever they issue those, they might package them up and sell them to other banks or other financial institutions, and take the difference of the interest spread. Or they'll what they basically do is they borrow money from the Fed, for a very low interest rate or a certain interest rate, and then they'll loan it back out to people who want loans or mortgages, and they'll take the spread, basically the difference between those interest rates. That's how they make money. Either that, or they take those deposits that people put into their bank and they'll invest it in very low risk, relatively liquid investments, treasuries, so basically U.S. government bonds. And those are basically zero risk. The problem with that is, and I'll get to it specifically for Silicon Valley Bank, why they were in trouble, is these bonds, you can't just, you can sell them, but in a very dangerous high interest rate environment, how bonds work is rates go up, bond prices go down. If rates go down, bond prices go up. They're inverse relation. So this is how banks make money. They take money that people deposit into their banks, they make investments, they'll loan it out to other people, and they'll make a profit off it. Otherwise, banks wouldn't be in business because they wouldn't make any money. If you deposited your money into the banks and they didn't do anything with it, they just let it sit there and let inflation kill it. So that's how banks make money. So in this particular case, Silicon Valley, and there's not really much wrong they did. And regulation wise, I don't know. There's a couple things that I guess the government can do to make sure this doesn't happen. At the end of the day, because there's this fractional banking system that we run, so only a certain percentage of the deposits that a bank has, they have to keep in cash, like at the bank. So if, say, there's $100 million at a bank from a bunch of people that put their money in the bank, so total that they have deposits of $100 million, and I can't remember the exact percentage, but let's just say it's 10%. So say the requirement by the U.S. government, by the law, is 10%. All right, you have to hold 10% at least in cash at your bank. Can't put in any investments or whatever. For people that do, if they do want to take out money, you can give them that money that is legally theirs. So 10% of 100 million is 10 million. So $10 million in cash. This is just a random example. Actual banks have billions and trillions of dollars. So if that's the case, they only have 10%. And in normal circumstances, nowhere close to 10% of people are all going to be like, hey, I want my money right now in the same time frame. But in the case that, say, everyone that deposit money in this bank, everyone at the same time, they go within the same day, same couple hours, they go to this bank and like, hey, I want my money back that I deposited. If they only have 10% of cash at that bank, then there's no way, it's impossible for them to be able to give everyone the cash that they deposited just because they don't have enough cash. It would take a little bit of time for them to either sell the investments they had or to get more money from the Fed or other sources. So this is essentially what happened with Silicon Valley Bank. There were some troubles with the bank. It's a public company, so they always, every quarter, they report on their earnings or the losses. And this most recent quarter, they reported, I believe, a $2 billion loss. And this was mainly because they put a lot of their investments, the cash that they received from deposits, they put it into U.S. treasuries. And these are U.S. government bonds. And like I said, with bond prices, interest rates go up, bond prices go down. So these are unrealized loss. So they haven't sold it yet. So it could easily go back up when interest rates, whenever they do, I don't think it's going to be anytime soon, go back down. The prices of the bonds will go up a little bit. And these are they invested majority in 10-year treasuries, 10-year bonds. And this was not good. And there was a couple other things that weren't really good. They had a scheduled stock sale for a lot of their executives. The CEO was going to sell $3.6 million of shares, and they were in a kind of the short-term liquidity crisis. And because with this high interest rate environment, a lot of these tech companies, I'm sure you've heard a lot of the tech companies laying off people. They're pretty tight with cash just because they're not selling, they're not raking in as much revenue as before during COVID. And because of this weird high interest rate recession like environment with the economy, they're tightening things up just because the near future is very uncertain. So trying to have a little bit more cash, limiting their expenses so they can survive whatever's to come in the future. So a lot of these tech companies, they're wanting to have a little bit more cash on hand, pull money out of the bank, and also, yeah. So basically, this caused a kind of like a short-term liquidity, and basically liquidity means like cash, having cash or not. They had a short-term liquidity issue on their hands because they had a lot of these tech companies that are probably wanting to withdraw a lot of their funds, and they didn't have a lot of cash on hand. So, and most of their cash was tied up in these 10-year government bonds, which have dropped dramatically in price because of the interest rates. So they kind of like looked around trying to raise capital, and as soon as kind of that news came out, that was not good news. So if you think of your bank and they're like, we're strapped for cash, we're trying to look around, see if anyone can give us cash, raise some capital, that's not a good thing. That kind of triggers more people to be like, hey, this is not a good sign. If everyone's to pull their money out, then if I have over a certain amount, there's this thing called FDIC, which is the Federal Department Insurance. Shoot, what is it called? Let me look it up. It is the Federal Deposit Insurance Corporation. Yeah. It basically insures for these FDIC banks anyone that has up to $250,000. If the bank were to fail, have no more money, and they can't promise to give your money back, the government will give you back your $250,000. But that's the maximum. So say you have $1 million in your bank account, only $250,000. If the bank were to fail, you'd get back. And that was a big issue. So a lot of these people have millions and millions of dollars in this bank. So essentially a bank run happened. So everyone wanted to pull their money out at the same time. And like in my earlier example, with our banking system, they don't need to have all the cash readily available to give back to the people that deposited in the bank. This was not good. So they didn't have enough cash. So they desperately tried to sell their investments that they had. And like I said, their investments were losing a ton of money because of interest rates. So they had to basically sell them at a huge discount, taking huge losses. And more people wanted to withdraw their money, and it was not good news. They basically ran out of money to give to people. And this caused a major commotion. This is not good because a lot of huge tech companies, if you think of like Roku, if you think of, I'm trying to think of the other companies as well that had money. Like think of any of your big tech companies, Coinbase, a lot of crypto companies had their deposits at this bank. And just imagine if you had millions and millions of dollars in a bank, and then all of a sudden the bank's like, oh, we don't have any more money, sorry. And you only get $250,000 with the FDIC insurance law. So you're basically kind of like screwed. And there was this other bank called Signature Bank. Essentially the same thing happened. I can't remember exactly how related it was to specifically to Silicon Valley, but I'm pretty sure it was pretty related. But this was not good news, and the bank stock obviously dropped a ton. A lot of banks were in stress because people were pulling their money out of other banks because this was the number one rated bank on Forbes. So this bank fails, then what causes any other bank that's most likely worse, less, it's not as managed as well, it's not as reputable. What is preventing them from failing too? So you see a ton of people withdrawing from their banks, especially smaller banks, because smaller banks are at risk just because they don't have enough liquidity, enough capital, versus say your credit union or local credit union or whatever. It's not going to have as much cash as say a Wells Fargo, Bank of America, Chase Bank. It's just not. So a lot of people were kind of moving their money, taking the money out. If it's below 200 or if above 250,000, you can take. Say I have $1 million, I'm going to take $750,000, spread that out between a couple of banks. It was kind of nuts what was happening, and that was not good. And then just the whole financial industry was kind of under duress. What was happening? People were worried about their money, both businesses and individuals. So that was the fiasco that happened this past week and past weekend. All right. So why is that important? It's important. Oh, and then the second thing is the government, because this was literally I believe the second worst bank failure in the U.S. history. The first one, I believe, was Lehman Brothers back in 08, 09, the Great Financial Crisis. So this is a big deal. This is not good. So the government, being the government that they are, they think they can fix stuff. All right, I looks like I got a question. I'll answer your question in a second. But just because I'm talking about the whole Silicon Valley Bank thing, and I'll go into, if you want to do a startup, like kind of some tips, even though I'm necessarily no expert. And granted, none of this is financial advice. It's just purely for information's sake. So if you make any investments, it's not my fault if they don't do well, or if they do really well. So what was I talking about? Oh yeah, it was the government coming in, bailing, basically not just Silicon Valley Bank or Signature Bank. They basically issued a statement saying, hey, for the next year, that the $250,000 FDIC coverage that will cover for people, there's no limit. So whether you have $5, whether you have $500 million, the government's going to cover it. Which, I mean, for those people that had money, it's great for them, because then they're like, whew, all right, like I don't have to worry about losing my millions and millions of dollars. But it basically spreads the risk from those people. And no matter what Biden says, can't trust necessarily a lot what Biden says nowadays. But Biden says, don't worry, this isn't going to affect the individual person. It's not going to take your tax dollars. We're not going to contribute tax dollars to bailing these banks out and saving these people's deposits. But indirectly, it does affect everyone, because it takes their risk and it spreads it out to everyone else in the United States. So whether that be interest rates, they're most likely going to pause them because it's not good. It's basically this whole weird economic, basically recession we're having right now, it's just going to be extended. This is what the government's doing. They're, instead of allowing these banks to fail, and not necessarily saying it's right or wrong, but there are going to be implications for it. So that means just this recession-like environment that we're having right now. I'm thinking of just like arbitrary, like random numbers. Instead of it being tough for 5 years, it might be tough for 10 years now because of this decision the government decided to make. So that's essentially what happened. So they bailed out everyone. Everyone's money was safe. And the thing is, it's not only just this bank, but this is for any bank, and I believe it's for like the next year or so. If I'm wrong, definitely let me know. But for the foreseeable future. And this is, I don't think is a really good idea. We just discussed this in my class, just because think about if you were an investor, if you were a bank, or just say you're just a normal person, and say you have $150,000, $500,000 in your bank account, and the government says, hey, no matter how much money you have, like if you lose it all, don't worry, we'll reimburse you. Think of what people are going to do. People are going to be stupid with their money just because, like, hey, I have a safety net or whatever. So I'm going to put my stuff in the pretty speculative stuff. It could make me super rich. It could basically make me broke, but it doesn't really matter because the government's going to give me back that money anyway. So that's the danger with it. So think about all these other banks that aren't as managed as well. They might try to take advantage of it, take on more risk, which could cause future bank failures as well. That's why I'm kind of staying away from, like, I kind of have my money diversified and I think it's fine, but I'm not suggesting necessarily or telling people to move their money around if you have over $250,000, but just be wary. I'd say definitely for people in smaller banks as well, just because, I mean, you don't know what your bank's going to do, and especially with this statement from the government, them bailing out pretty much everyone, who knows what they could do. So it's just something to be aware of and wary of. So yeah, it's kind of everything that's happening, and in the future, just like I said, it's just going to cause more issues, more instability for the economy, just because they're spreading out this risk to everyone instead of just those people for being in that bank that failed. So just a reminder, any bank could fail at any time if everyone decides to take their money out at the same time, but bank's not going to have enough to cover it. So kind of some side things that also relate to that. It was interesting. If any of you are into crypto, then you probably saw this past week, it's back up in the peg now, just because with the government news of them basically bailing these banks out. But USDC unpegged from $1, and that was a big deal because Circle, the company that runs USDC, they had, I believe, like 3.3 or 3.6 billion dollars of reserves in Silicon Valley Bank. So obviously, when they heard the news that Silicon Valley Bank failed, then a ton of people, because essentially what any stablecoin, and specifically USDC, they were pretty transparent. They let everyone know that was their thing. It's like, we're 1-to-1. For every one USDC there is in circulation, we have $1 in reserves to back it up. But if you just have $3.6 billion just overnight just disappear, then that means it's imbalanced. You don't have a 1-to-1 backing of USDC. So naturally, the price of USDC is not going to be $1, just because there's not an equal amount of dollars in reserves to back up each one USDC. So that depegged around from the dollar to like 90 cents, which is a pretty big deal. And I guess if you knew that the government was going to come out and bail them out and everything was going to be fine, because it eventually restabled back up to $1 from 90 cents, you could have made pretty good money. 10-cent difference, you could arbitrage it, but I mean, no one knew that the government was gonna come out and bail out the Silicon Valley Bank and these other banks, to basically be like, there's no risk, you're not going to lose any money. That $3.6 billion you had is still technically there. So you could have made a lot of money. You bought it when it was 90 cents, and then it jumps back up to $1, and then you could sell it back for $1. But essentially, a bunch of people were selling it off because they weren't sure if it was the USDC whole thing was going to collapse, and just like Terra Luna basically collapsed the value of it. Just people kept on selling, and price dropped dramatically. So something similar could have happened to USDC. That's why people. It's interesting. You obviously USDC dropped because everyone was selling it, and then you look at Tether. Tether was spiked up to I believe like $1.06 or 7 cents or something like that. So a ton of people were buying into Tether because they wanted to swap out their stablecoin. So people had a lot of Tether. You could have sold Tether for a pretty decent profit if you had a ton of Tether. Anyway, that's kind of a side effect of that in the crypto space from these banks failing. And it'll be interesting to know what the Fed does from now on, because their whole thing is like they want to do a soft landing and basically not have a ton of stuff go wrong at the same time and totally destroy our economy. Which, if you think about it, like the inevitable is going to happen. Like, we're in a recession, things are going to be bad. It's whether you want to have it like really suck with a short amount of period of time. It's kind of like, I guess, like running a marathon or something like that. You could run a marathon all at once, the full 26.2 miles, or you could stretch it out over like a long time. But the thing is, like, if you kind of like get it over with, it's more painful but shorter amount of time instead of just continuing suffering in poor economic environment. So it's kind of your trade-off. So that's kind of the deal with the Silicon Valley. What it means, because everything with these banks, it looks like they somewhat kind of, at least they think they figured it out. But it'll be interesting to see what Jerome Powell and the Fed do. There's a lot of talks of them pausing rates because them continuing to increase rates is just going to cause more economic troubles, possibly more bank failures. So it's going to be interesting to see what they do. But we're going to be in this for a little bit longer than everyone thought. So that's kind of the result of it. Let's see. Vacuum the garage. I forget who that is. Shoot, I'm trying to look at I forget which one of my followers that is, but all right, he's looking to grow a startup. I don't know if you're still here or not, but that's what he said. I'm no necessarily no expert in startups. I've never really started up a company of my own. I'm hoping to in the future for sure. I currently kind of work for a startup right now. So, and I've worked for a couple different startups before. I would say the main thing is if you already have an idea, if you're not super familiar with that industry or that business, if you're not an expert yet, which you need to become an expert, if you're going to become an entrepreneur or start up your own business in any way, you need to become an expert in the industry that the business you're going to try to start. So the biggest thing is mentorship. And I would say we've been working for someone who's in your industry or getting a ton of mentorship, a ton of advice, even paying them for that information, for that advice, to see like kind of what went wrong with them, what they did right. That way you can dramatically increase your efficiency and decrease the amount of time that it takes you to become a profitable, successful business. So that would be my recommendation. Working under someone who knows the business very well. That way you can, there's this acronym that Rich Cooper, the Unplugged Alpha, says all the time. And I think it's genius. He says, basically learn as much as you can. And then you hear of all these companies doing R&D. He's like, do your R&D. R&D doesn't stand for research and development. It stands for rip off and duplicate. So essentially that's what you should do, because there are very few people that come up with business ideas that are successful, that are one of one, unique. You're the first of the industry. It's very, very unique. And for most of the time, you might be ahead of what the market wants at the time. So think about Tesla, Elon Musk. If Elon Musk would have started or tried to found like Tesla and essentially what it is with electric vehicles in say like the 60s or 70s, he was like a way ahead of the time that there was any demand for that stuff, let alone technology. And technology is a big one too. Like flying cars, I think we have the technology now, but say like 50 years ago, people were trying to develop flying cars. It's like, cool, it's a really cool idea, but we just don't have the technology, advanced enough technology to be able to manufacture something like this, to invent something like this. So the idea is cool, but you might have some things, whether that's market demand or technology, that's lagging, and you might have to wait for that. So those are kind of my ideas and advice for startups. All right, what's up, Garrett? I don't know if you're still here. Yeah, what's up? But that's about it. For those of you that kind of just joined or came in later, I basically explained the whole Silicon Valley Bank crash and the implications with that, why it was important, kind of the basics of what happened with the crash, why potentially any bank could fail, could crash, and why there is cause for concern. And just to be wary of, not necessarily to pull out all your cash, put it under your mattress, but if you have a ton of money in one bank, maybe it would be a good idea to potentially diversify that money, whether it be into investment or into another bank. That way you kind of cover your bases. And not only the immediate implications of these bank failures, but some long-term effects that could potentially affect the economy and could affect businesses as well as individual themselves and retail consumers and retail investors. So it's kind of my 2 cents. This I didn't want this stream to be super long. I know I can get into the weeds a lot just because of my background, and I understand a little bit more than the average person would. But a lot of the stuff is really important. I think the average person should kind of have more of a grasp of financial information and just how money works and how the whole financial system works in general, just so you don't get screwed by it. Because I'd say financial literacy is kind of what keeps people in poverty and keep people from becoming successful and kind of advancing in socioeconomic status, just because they don't know how it works. And that's why the rich keep getting richer and the poor keep getting poorer, because the rich people, they know how it works, they know how the game works, and they use it to their advantage. And poor people, they don't know how it works. A lot of people don't care to know how it works, and they get taken advantage of, unfortunately. But that's capitalism. All right. Appreciate everyone that tuned in. And this is gonna be recorded, so it's gonna be on my YouTube. It's gonna be on my IG as well. So if you're on my IG, definitely check out my YouTube. I put the link in my story. Check out my channel. I've done like 6 or 7 of these lives so far, and hope to do a lot more. Typically do them weekly. So, all right, catch y'all later.